Hello students. In this video I'm going to walk you through how to do question 14 in your chapter 1 homework assignment. So I'm here on Blackboard, as you can see, and after I make this video I will put the link to the video down here, and then I'll post an announcement saying I've done this. And then the actual assignment, when I'm working through it, I'll work it here in this in a PDF, and I'll save the PDF and I'll post the PDF in this folder. I'll call it question 14 chapter 1 homework. So I'll follow these procedures the rest of the semester. I may not make a video on every homework problem I work. If I'm able to get through it in class, then I'll just post the PDF in here and I won't make a video on it. But I didn't get through the problem in class on Thursday, so I'm deciding to just make a video on the problem. I'll put the PDF in here and I'll put the video link in here. Alright, so let's go into our homework assignments, chapter 1 homework. And then I suppose let's just do a student view and then go to, actually it's probably easier if I just go down here to question 14 and then we can look at it. The thing is, I don't know if it'll have the answer automatically. Will it have the answer? Yeah, it does have the answer, but I'll just show the given information here. So we were working this in class on Thursday, and I believe you're going to get, it's the same question, but the name of the company may or may not be different for every student, and the actual dollar values that are given in the given information may be different. But the same process that I use to solve this particular problem will work to solve your problem. You'll have the same problem 14, it'll just maybe have different numbers. And so in this problem, what we're doing is we're illustrating the how to account for economic events that happen within the company. We're not going to show you how to make the journal entries yet with debits and credits, but we are going to show you how each of the economic events, each one of these 11 economic events, how they affect the accounting equation. What accounts do they affect, and then for each of those accounts, does it go up or down in balance, and then overall, does assets, liabilities, or owner's equity go up or down? So the accounting equation. That's what we're doing in this problem. So before we get into this question, we should define a couple of terms that is going to come in handy in this problem. I mean, a lot of these terms are defined, all of them are defined in the PowerPoints, but I want to go back to two particular terms and define them very carefully here because students often struggle with these two terms. So let's take revenues and expenses, or we'll just say revenue and expense. So a revenue, the definition of a revenue is, first of all, a revenue must be recognized, which means the word recognized just means that the revenue is booked in the company's books. They make a journal entry for it, and the revenue will affect the accounting equation. It'll make stockholders' equity go up. So a revenue must be recognized when it is earned, according to the accounting rules, GAAP. And earned means, so revenue is earned. So we have to define earned. Revenue is earned according to the accounting rules when the company ships the goods, or in the case of a service provider, provides the services. to the customer. The moment a company ships goods or provides services, that means the company has earned revenue and they have to book the dollar value of the revenue, even if the company hasn't gotten any cash yet from the customer. So notice we did not define revenue as revenue must be recognized when cash is received. So when we get cash, that's revenue. We didn't define it that way. This is the definition of revenue according to the accounting rules. And it probably is slightly different than the definition you're used to. Analogously, expenses are also, the definition is different than what you would expect. An expense is not when we pay cash for something. An expense, first of all, according to GAAP, must be recognized when it is earned. I'm sorry, when it is incurred. So with expenses, we got this word incurred that we have to define, and with revenue, we have this word earned that we have to define, and we did that. So when is an expense incurred? Expense is incurred when the company derives a benefit, an economic benefit, so a benefit that we can measure in dollar terms, from using an asset. Usually that economic benefit that's derived from using an asset is the cost of the asset, but not always. For example, when a company buys a piece of equipment, the minute they use that piece of equipment, the company has incurred an expense. So when they pay cash $10,000 to buy a piece of equipment, they haven't incurred an expense yet when they did that. Paying the cash for the asset is not the expense. So now they have this asset. Until they use the asset, they haven't incurred an expense. The moment they use the asset, that means we are deriving an economic benefit from using the asset. Then we can start recognizing some expense. We start booking some expense. It's called depreciation expense. So this is the definition of an expense. This is the definition of a revenue. And we should also define an asset, a liability, and so forth and so on, common stock. But we did that in class on Thursday. And the definitions of those things are easier for students to grasp. But these are the two terms where the definition usually students struggle to grasp. So with that out of the way, we'll be using these here in this problem. So we have an accounting equation as a company. We're going to say assets is on the left-hand side. The balance in all of our asset accounts, if we add up the balance in all of our asset accounts, we should get, I'm going to do it this way here. We should get whatever the balance in all of our liability accounts is, plus whatever the balance in our stockholders' equity accounts is. If we add those up, there's two stockholders' equity accounts. There's common stock and there's retained earnings. I don't have enough room to finish it, but retained earnings. And collectively, these two pieces of the accounting equation are referred to as stockholders' equity. Move this down here a little bit so I can have more room. This is collectively referred to as stockholders' equity. It's the sum of common stock and retained earnings. So this equation right here, it's got a left-hand side, left hand of the equal sign, and a right-hand side. It has to stay in balance. So every transaction that happens at the company, when the company accounts for that transaction, after the accounting is done, the equation still has to remain in balance. So when the company, before the company, so initially, the company has no assets. So the dollar value of their assets is zero. They have no liabilities and they have no owner's equity. So the equation starts at that. And then the minute the company becomes a company, the moment the company becomes a company, usually that happens, well, we'll say if they're publicly traded, usually the first thing that happens, in this class, I'm going to speak from the perspective of a publicly traded corporation. So everything when I say a company, I mean a publicly traded corporation. So the way the publicly traded corporation comes about is they get a huge initial inflow of money by issuing their stock. They have an initial public offering. And that makes assets, cash, go, up to how much ever cash they got, say 50,000. Liabilities are not affected. And common stock goes up by 50,000. And that's the first transaction that starts the company off. See, the equation is in balance. And they have no retained earnings. 50 equals 50. Every transaction that happens at the company, after accounting for the transaction, so here's the first transaction that happened and we accounted for it. The equation has to stay in balance. That's the idea. Now, retained earnings is comprised of three pieces. There are three things that affect retained earnings: revenues, expenses, and dividends. Revenues make retained earnings go up, expenses make retained earnings go down, and dividends, which are not an expense, they make retained earnings go down. So with all that information in mind, let's work this problem. So number one, I'm trying to get to it won't let me. I can't pull up the website for some reason. Let me move my computer here. There it is. Got locked there for a second. So number one, make it a little bigger. Well, I guess it's big enough. Stockholders invested $10,000 cash in the business in exchange for common stock. So Fredonia Repair Incorporated, that's our company. That's us. We were started on May 1st with this first transaction. Stockholders invested $10,000 cash in the business in exchange for common stock. So the effect on the accounting equation is assets go up by $10,000. In particular, which asset goes up by $10,000? Cash. And liabilities are not affected. So let me move this over a little bit here. Liabilities are not affected by this transaction. And common stock goes up by $10,000. Retained earnings is not affected. So the equation stays in balance. Well, shoot, I'm having all kinds of trouble getting the darn. What if I just minimize? Yeah, we'll just minimize. second transaction is we buy equipment for cash, $5,000 worth. So our cash goes down by $5,000. So, and it's an asset. Cash is an asset. And our equipment, the dollar value of our equipment goes up by $5,000 because now we have $5,000 worth of equipment that we didn't have. And equipment is also an asset. So after transaction 2, the equation is still in balance. Liabilities are not affected by the second transaction. Common stock is not affected, and retained earnings is not affected. The reason retained earnings is not affected is because revenue is not affected, expense is not affected, and dividends are not affected. Even though we paid cash for the equipment, we have not incurred an expense yet because we have not derived a benefit from using an asset yet. We haven't used the equipment yet. Once we use the equipment, then we have depreciation expense because we've had to derive the benefit of using it. So transaction 3, we pay $400 cash for May office rent. And supposing we do that on May 1st, if we pay for the rent on May 1st, and that's how rent works, you prepay, you always pay at the beginning of the month, or else the landlord doesn't allow you to occupy their space unless you've paid them. So $400, that's a decrease in cash, which is an asset. So assets will go down by $400. And have we derived a benefit yet from using an asset? Have we been able to occupy the space yet that we just paid to rent for the month? As of May 1st, have we occupied the space yet? We have not. So we have not incurred rent expense yet. We will incur rent expense by the end of the month once we've stayed in the whole. We've derived a benefit of being able to occupy that space for the month. But as of May 1st, we don't have an expense. So cash goes down, but another asset called prepaid rent goes up. I should have be consistent here with how I'm labeling things. So cash is assets are going down by 400 cash, and assets are going up by 400. Which asset goes up? Prepaid rent. So the net effect on assets when we pay for rent at the beginning of the month is no effect. The net effect is they cancel each other out. So the equation stays in balance. You might wonder, what's this prepaid rent? Prepaid rent, the definition of it is the right to occupy a space that you don't own in the future for a certain amount of time. So it's an asset. Now, after we've occupied that space for the month of May, then at the end of May, then we've completely used up this prepaid rent asset, that right, we've completely used it up. So that would decline, would go down by 400. And the rent expense would go up by 400 because we've finally derived a benefit from using this. Until we occupy the space, we haven't derived a benefit from using the prepaid rent asset. Therefore, we have no expense. But by the end of the month, we have the expense. So this is the correct answer for number 3. However, in the homework system, they're not going to accept that as correct. They want you to instead, so this is the correct answer. But what they want you to do is just go ahead and call it an expense. They want you to say expenses go up by 400, which makes retained earnings go down by 400. And the equation still, if you did that, would still be in balance. But this is not the correct entry. And we'll find out when we get to chapter 2 that the way I did it the first time, with the cash and the prepaid rent, not rent expense, is correct. But in chapter 1, they don't want to go through all the they don't want to explain about prepaid rent yet. They just want to introduce you to things a little bit at a time. So they don't even talk about prepaid rent in chapter 1, and they just assume that they just let you think that it's rent expense. But technically, no. As of May 1st, we don't have any rent expense because according to the definition, we only have an expense when we derive an economic benefit from using an asset. And as of May 1st, we haven't used the space, we haven't occupied the space, so there's no expense. But we'll go ahead and appease them. And you need to put what I have here, in this row. That will be the answer that the system accepts as correct. But this right here is the correct answer. So once we get to chapter 2, you will see this is the correct answer. That's not right for this problem. And then it'll be that way the rest of the semester. But for now, this is what I wanted to explain in class, but I was running out of time on Thursday, so that's why I went ahead and made this video. Transaction 4. So we'll go with what they said because later answers depend on what you've done previously, and so we'll just go with that. We pay $300 cash for supplies on May 1st. This is the same sort of idea. We pay cash, so assets are going down. Cash is going down by $300. And we bought supplies. So supplies, this is not the same thing as the previous number 3. So supplies, which is also an asset, goes up by $300. We have not incurred an expense yet until we use the supplies, right? Once we use the supplies, then we've incurred supplies expense and we'll book it. This is the answer they accept as correct for this one. Cash down, supplies up. So the equation stays in balance. Five, incurred $250 of advertising costs in the Beacon News on account. And right there, they're telling us that we've incurred an expense related to advertising. But we haven't paid cash for advertising yet because it has the phrase on account. Anytime you see the phrase on account, that means we've received something from a supplier or a creditor and we have not paid for it yet. So we have a liability called an account payable, and we did not pay cash. And it says incurred $250 of advertising, and so they're basically saying we have advertising expense, $250. And when you have an expense, that makes retained earnings go down, like I said earlier. So the $250 increase in advertising expense makes retained earnings go down. Now we're assuming this is really only correct. I mean, this is what the problem will accept as correct in the system. But in reality, this is only correct if we in fact have already derived the benefit from using the advertising according to our definition. We can only book the expense once we've derived the benefit from using the advertising. And how do you derive a benefit as a company with advertising? Well, your commercial or whatever, your advertisement, it has to have appeared, for people to see. If it hasn't appeared yet, if it hasn't shown up on television or it hasn't appeared in a magazine yet, but we've already paid for it, then we haven't incurred an expense yet. But in this question, they're assuming that it has appeared. And that's why they say we've incurred advertising costs. They use that word incurred. So advertising expense goes up, retained earnings goes down by $250. But if that's the only thing that happens, then the equation is out of balance, right? Because the right-hand side of the equal sign went down, but the left-hand side didn't change, so the equation would be out of balance. But it said that we incurred this advertising cost on account. It uses that phrase, on account, which lets us know that we didn't pay for it yet. We owe the television station or the magazine company, we owe them money for the advertisement that they're going to do for us or that they've done for us. And so we have an account payable. So liabilities go up. And the liability that goes up in this case is called account payable. We receive some good or service from someone, but we haven't paid for it yet. Then that's the definition of an account payable. notice the equation stays in balance. The right-hand side of the equal sign goes up by 250, but then it goes down by 250, and the left-hand side doesn't change, so the equation will stay in balance. I'm struggling with getting this back to struggling with my laptop. I'll just do this. Number 6, we received $4,700 in cash from customers for a repair service. So we are a repair company, Fredonia Repair. And so now what 6 is assuming is that we've already completed the repair service for that customer. That's what they're assuming. And if we've already provided the service to the customer, then by definition we've earned the revenue, and we have revenue. We have to recognize revenue. So we have cash going up by $4,700, which makes assets go up by $4,700. And then we have revenue going up by $4,700, which makes retained earnings go up by $4,700. Equation stays in balance. All right, number 7. Declared and paid a $700 cash dividend to our shareholders. So cash, which is an asset, goes down by $700. And dividends, which is not an expense, it's its own separate thing. Dividends go up by $700, which makes retained earnings go down by $700. Remember what I said earlier, retained earnings, there are 3 things that affect it. Revenues make retained earnings go up. Expenses make retained earnings go down, and dividends make retained earnings go down. So revenues have a positive relationship with retained earnings, and expenses and dividends both have negative relationship with retained earnings. In fact, the equation for the balance in retained earnings is, we'll give that here in a minute. We'll need that. 8, we pay a part-time, one of our employees, there's a salary of $1,000. So we have cash going down by $1,000. So assets go down by $1,000 since cash is an asset. And we have salary expense going up by $1,000. Now I'm assuming that we're paying our employee, but we're paying them after they've worked for us. We're not paying them before they worked for us. If we pay them before they work for us, then we have not derived any benefit yet from them working for us, and we have not incurred an expense. But with employees, usually you pay them after they work, which means we have derived the benefit of them working for us, so therefore we've incurred the salary expense. So salary expense goes up by $1,000, which makes retained earnings go down by $1,000. There's a negative relationship between expenses and retained earnings, like I said just a minute ago. Number 9. We paid a utility bill of $140. So cash is going down by $140, which will make assets go down by $140. And assuming that we've already derived the benefit of using those utilities, so we're paying the utility bill after we've used the utilities, then we have derived the benefit of using the utilities, and we have a utility expense. So utility expense would go up by $140, which would make retained earnings go down by $140. Number 10, performed repair services worth $1,100 on account. So 10 and 6 are similar. With 6, we performed repair services and we got cash from the customer. With 10, we performed repair services, so we've earned revenue, but we haven't got cash from the customer, and we know that we haven't gotten cash because it says on account. So that means we've done stuff for them, but we haven't received any money from them yet. So we have an account receivable with our customer in this case. So we have accounts receivable going up by $1,100, and accounts receivable is an asset. And we have repair revenue going up by $1,100, which makes retained earnings go up by $1,100. And then finally, number 11, collected cash of $120 for services that we billed to the customer from transaction 10. So we sent them a bill for $1,100, and in transaction 11, we collect $120 of that. So they still owe us $980, but we collect $120 in part 11. And so cash would go up by $120, so cash is an asset. And then $120 of our account receivable asset that we have with our customer, since they just paid it off, they paid us for it, then our accounts receivable asset declines by $120 with our customer. See, the equation stays in balance. So if you look carefully, every transaction, the way we accounted for the transaction, the accounting equation stayed in balance. The left-hand side went up or down by the same amount as the right-hand side. So that's part one of the problem. Or that's part A. Prepare a tabular analysis of the transaction. Oh, and the revenue, instead of calling it repair revenue, they decided to just call it service revenue. That's what they're telling us there. So wherever I wrote repair revenue, just write service revenue. Just call it service revenue. I mean, that's what it is. It's a service. What kind of service? We did repairs for them, but in general, it's just a service. Contrasting that with sales revenue. So you have sales revenue when you ship or you ship goods to the customer, physical goods, and you have service revenue when you do something for the customer other than shipping goods, like you cut their hair if you're a barber shop, or you repair their car in this case. For example, supposing that we're an auto mechanic, it just says we're a repair company. It doesn't say what we repair, and so if you look here. If you look the way they've done this, they've taken assets, the left-hand side of the equation, and they've broken it down into all the assets that were affected in all of these 11 transactions. So if we look down through this column on assets, we got cash, we have prepaid rent, but we decided that even though that's the right way, this problem, we're not going to use that, so we won't have prepaid rent. But we have cash, we have supplies, and we have equipment, and we have accounts receivable. So those are the four assets that were involved in these 11 transactions: cash, supplies, accounts receivable, and equipment. 3 of those 4 assets are short-term or current assets, and one of those 4 assets is a long-term asset. Equipment is a long-term asset because we intend to keep that equipment for more than a year. So if you come over here, you can see they've taken the assets and they've broken them down, the assets that were affected by these 11 transactions: cash, accounts receivable, and supplies. And then they put the equipment, they put the current assets first, and then the equipment came at the end. And then we go over to the right-hand side of the equation, and we have liabilities. The only liability that was involved in the 11 transactions was accounts payable. So they have the $250 increase in accounts payable there. And that was in transaction 5. And then the accounts that are involved in retained earnings, in stockholders' equity, are common stock. So that was involved once here. And then retained earnings, that was involved 1, 2, 3, 4, 5, 6, 7 different times. And so they should have that. So retained earnings, they go ahead and break it down: revenues, expenses, dividends, like I said. And so at the end of these 11 transactions, you can get the ending balance in each of these accounts. You can get the ending balance in the cash account. You can get the ending balance in the accounts receivable account. You can get the ending balance in the supplies account, and so forth. And so let's go ahead and do that. Let's verify that our total, if we take our assets and break them up, cash, accounts receivable, supplies, and then equipment, those are our four assets. The sum of the balances in those accounts should equal the sum of the balance in the liability accounts when there's only one liability, accounts payable, plus the common stock account, plus the three accounts that affect retained earnings, which are revenue, expense, except expenses are a subtraction, right? Those reduce retained earnings. And then dividends. I'll move this over. So if we draw a line underneath all this. So cash's ending balance should be 10,000, then minus 5,000, then minus 400, then minus 300, then plus 4,700, then minus 700, minus 1,000, minus 140, plus 120. And if you add all that up in the calculator, you should get what they got. 7,280. So that's cash's ending balance. What was cash's beginning balance? 0. Ending balance, 7,280. So before these 11 transactions, cash had a balance of 0 because the company didn't exist yet. And then after these 11 transactions, the balance in cash is 7,280. What's the balance in accounts receivable? Well, we have 1,100 and then minus 120, so it's still sitting on our books with a balance of 980. We're still owed 980 by our customers, so that represents that's an asset, right? As of the end of after these 11 transactions, we have that account receivable asset still that we expect to collect in the future, and that's why they have a $980 balance here in accounts receivable. Supplies has a balance of 300, and equipment has a balance of 5,000. Accounts payable has a balance of 250, it looks like. Let me add another page here. Common stock has a balance of 10,000 still. 10,000 was initially invested, so our shareholders own $10,000 worth of stock. And then the total revenue for these 11 transactions would be, I accidentally. Our first revenue was this service revenue of 4,700, so this number plus the 1,100 of revenue we earned here. So in total, should say $5,800 worth of revenue. So if we look at the answer, it should be 5,800 for revenue. There it is. See here. And then the balance in expenses should total up to 1,790. And we put a parentheses around them because we're going to subtract that balance because expenses reduce retained earnings. And then the balance in dividends should be the $700. And we put parentheses around it to indicate that we're going to subtract that. And so let's check, does this equation, does this work, does this hold? Let's check with our calculator here. $7,280, the balance in cash, plus $980, the balance in accounts receivable, plus $300, the balance in supplies, plus $5,000, the balance in equipment. So our total assets as of after these 11 transactions is $13,560. Our total liabilities are $250 because we only have one liability, accounts payable. And our total owner's equity, this is stockholders' equity. This is liability. This is stockholders' equity. And these are all our assets. Our total stockholders' equity would be $10,000 plus $5,800. Minus the 1,790 minus the 700 equals 13,310. Does 250 plus 13,310 equal 13,506? I must have added these numbers wrong. That can't equal 13,506. Let's go back and add up the left-hand side. 7,280 plus 980 plus 300. It's 5,000. It's 13,560. I just transposed the 0 and the 6. So after these 11 transactions, total assets should be valued at $13,560. And so the left-hand side is 13,560, and the right-hand side is 13,560. If you add those two numbers together, you get 13,560. So check. We must have accounted. Well, this lets us know at least we still may have made an error, but if the left-hand side doesn't equal the right-hand side, then we know we made an error. If they do equal each other, we may or may not have made an error. For example, we may have called this account payable. We may have put it over here as revenue so that our balance and liabilities at the end is just 0, but the revenue's added over here. The two sides would still equal each other, but we made an error. But in our case, we know we didn't make an error. The two sides equal, and we did everything correctly. Do it that way. All right, let's see what else they want us to do. Part B, so that was Part A. In Part B, they want us, from an analysis of the retained earnings columns, compute the net income or the net loss for May. This was Part A. So just analyzing retained earnings, we can compute net income. So net income, the formula for net income is equal to the total revenues this period minus the total expenses. That's net income. So the total revenues were right here, 5,800. We've already added them up. And we want to subtract the total expenses, which were 1,790. And so net income would be that number, 5,800 minus 1,790, 4,010. Whoops. There's the answer to B. Now the way they do it, if you look here, they break it down. So they have service revenue totaling 5,800, and then the expenses here, they go ahead and break them up into their categories, because we had salaries expense, rent expense, advertising expense, and utilities expense, if you remember here. There's advertising expense, here's salary expense, here's utility expense, and here's rent expense. And by the way, there's not an order. For right now, you can put these 1, 2, 3, 4 expenses in any order you want, and the system will accept it as correct. But generally, you want to put the bigger ones first if possible. And then you get a subtotal on those expenses. So that subtotal is the 1,790, as you see. And then you subtract the total expenses from the total revenue to get the net income. In this case, net income is positive number. If the revenue was less than the expenses, then when you did the subtraction, the net income would be a negative number, and you would report the negative number in parentheses. You don't ever put negative signs when you're reporting the accounting information on the income statement. This is the income statement for the month of May. So these 11 transactions happened, and during the month of May, our net income was $4,010, which is the excess of our revenue over our expenses. If the 4,010 happened to be negative, let's say the revenue was 1,790 and the expenses happened to be 5,800. So when you do the subtraction, you get negative 4,010. You don't write the negative sign on the income statement. You just put the 4,010 in parentheses, if that was the case. So I just computed net income the shortcut way, but they wanted you really to make an income statement. And so you saw that there in the video. Maybe I should do it down here. Notice how when they make the income statement, you always, the format for an income statement is name of company, then you give the name of the financial statement. This is the income statement. And then you tell the user on the third line, whoever's reading this statement, over what period of time is this statement reporting? And it's reporting for the month of May. Move this over a little bit, kind of center it better. And then you list the revenues first and their balances. Which was 5,800. And then you have a subtotal for the expenses. I'm sorry, then you have a category for the expenses, and you list them each one at a time. I'll just list them in order that they happen during the month. So well, I'll do it the way they did it in the book, in the online system. I'll put the biggest one first. Salary expense. You got to indent here a little bit. Salary expense was 1,000. Then what do we have? What was the next biggest expense? Rent was 400, advertising was 250, and utilities was 140. So we got rent expense. I'm just abbreviating here. 400, advertising expense. $250, and then the utility expense of $140. And then you get a subtotal on the expenses. So our total expenses. And generally, let's do it this way. You put these over here. And then your subtotal on the expenses goes right here. That way, you can have your net income row, which is the revenue minus the expense, 4,110. If you get a negative number, when you take revenue minus expense, like I said earlier, then you would put a parentheses around that number. You would just go like this. If it happened to be negative 4,010, you would write it this way, and you would write the word loss right here instead of income. But in this case, we got a positive number, so it's like this. And that is problem 14 on homework 1. I don't think there's anything else, is there? That was it, just 2 parts, A and B. So I hope this was helpful for you. And I will save this as a PDF and upload it to Blackboard where I said I would at the beginning of the video. And then I'll put the link to the video and then I'll put an announcement on Blackboard. And this will be the process I use throughout the semester of working things for you. you'll find it helpful. I hope you'll find it helpful.